In these higher rate times, there are options to help ease the pain of the mortgage in the initial years. One option is a temporary buy-down option. You may have also heard it called a seller buy-down, or as we will go through here, a 2-1 buy-down in this case. There is a lot of confusion about what exactly it is and how it works, and I'm hoping to clear some of that up for you in this video. At a basic level, the buyer uses seller funds to subsidize their monthly payment for the first couple of years. In the case of the 2-1 buy-down, the note rate is going to be market determined, but the first year the borrower will make a payment at an effective rate that is 2% lower than the note rate. In year 2, the payment will be effectively 1% lower. As a hypothetical example, let's say when you close on your loan, the note rate is 7.5%. In this case, the first year, your payment is effectively at a 5.5% rate, and year 2, the effective rate of 6.5%. But this is a temporary buy-down. If you haven't refinanced by year 3, your payment rate goes to the full note rate. How does it work? When you and your agent put your offer in on a property, you request a credit from the seller to cover the cost of the buy-down. Those funds are collected at closing, and the lender holds them in an escrow account and uses them to offset your payment accordingly for the first 2 years. This is why I say the borrower's effective payment rate is lower, because these are the funds used to make up the difference. A nice thing about this model is that if you do refinance in those first 2 years, you're not leaving any money on the table. Any remaining funds will be credited to your loan balance. What would it look like in practice? There's a helpful calculator on my website that would show the borrower's first year, second year, and remaining term payment. In this case of a $250,000 loan at a 7.5% interest rate, in year 1 you would save $328 a month on your payment. The website calculator also helps you figure out how much is needed. In this case, the seller credit would need to be $5,957. You may be asking, if the seller is going to effectively make $6,000 less on the sale, why wouldn't I just offer $6,000 less? If your loan was $244,000 instead of $250,000, at the same rate, your payment would be $42 cheaper than the note rate. But year 1 with the buy down, you would still save $286, as your payment would be the $1,419 instead of the $1,706 at the lower loan amount. Again, this is a temporary solution to today's high interest rates. If you feel rates will go down in the next few years, you're not expecting to have the home for very long, or you're expecting a future pay bump, this can be a way to help you manage your cash flow in the immediate future. Basic requirements to use the buy-down option: it has to be a primary residence, a purchase with a 30-year fixed rate. Most loan types do qualify. You have to qualify at the full note rate. This is not going to help you get into a more expensive house. You still have to be able to afford that 30-year note rate. There are other temporary buy-downs such as a 1-0, a 3-2-1, and a 1-1-1. Again, there's a lot to keep in mind here if you're considering this option. It might be a good strategy if you feel rates are going to come down or for the other reasons we've talked about. If you do refinance before the seller credits are used up, they are credited back to you, so you haven't lost anything. On the negative side, depending on the market, asking for seller credits can make your offer less attractive. Also, if you are getting seller credits, you should look at all of the ways they could be used, for instance, using them to offset closing costs. If you'd like to know more about the buy-down option or know the other options that could be available to you, please reach out to me. I'd love to talk to you.